Well, welcome everyone to today's webinar. Very excited to have you all here and joining us today. Lots of great information, so we will hop right into today's presentation. My name is Matt Wilson. I am the President and Chief Investment Officer here at Keen Wealth Advisors, and what we do is we help people transition from being dependent on a job and working to independent and retired. And there's a lot of things that go into that, whether it's decisions around Social Security and Medicare, but also a lot of tax planning that is involved throughout that transitional period, but also throughout your lifetime. How do you invest the money that you have to make sure it lasts your rest of your life, and how do you take distributions in an efficient way? So we're going to cover a lot of that today in today's webinar about the decisions that you're facing as you approach and even enter into retirement. We're headquartered here in Overland Park, Kansas, and we have clients throughout the United States. And hopefully today you're able to learn a few things about current tax law, what some of the rules and regulations are currently, and some of the decisions that you're facing. Now, we cover these things from a very high level to just provide the context, the information, but sitting down with us one-on-one, going over your unique situation is very important and one of the key components to this. Now, we also have a lot of clients on today's webinar as well, so a lot of these things our planning team will address for you, of course, as you're going through these stages. But again, I think it's always helpful to be educated on these things as as you face these decisions. One thing I do want to point out is that we do have our blog, podcasts, and our webinar replays. They're hosted on our website, keenwealthadvisors.com. And if you go under the Retirement Resources tab, you'll be able to find all of our historical blog posts, podcasts, and webinar replays. And then lastly, we've added a new channel, our YouTube channel. Check that out at youtube.com/keenwealthadvisors. And we have content on there, video versions of our podcast, and other content that isn't available anywhere else. And if you'd like a copy of Mr. Keen's book, Keen on Retirement, Engineering the Second Half of Life, please let me know. I'm happy to send a copy of that out to you. That's at our expense. So whether you've got a existing copy that you'd like to replace, or if you've got a family member, friend, colleague that you'd like us to send one to, shoot me an email. Happy to send that out. mwilson@keenwealthadvisors.com. Well, let's get into today's presentation. We're going to start talking about Social Security and Medicare. There's some things I find helpful, the defining some of these frequently used terms regarding Social Security. One of them being your full retirement age. And that's an important piece to this, because that is the age when you're first entitled to your full or unreduced retirement benefit. And that's a moving target. I'll show you what that is for everyone here on an upcoming slide. We also have what's called your primary insurance amount. So that's the benefit you would receive if you elect to begin receiving benefits at your normal retirement age or your full retirement age. So again, that's a unreduced benefit. And then of course, Social Security Administration, a lot of times abbreviated as SSA. You can go to ssa.gov, get a copy of your statement. And I think it's good for folks to get that account established, especially prior to you wanting to begin your Social Security benefits. There are offices that you can go to, local branches that you can go into and turn on your benefit, ask questions, things like that. But also their website is very useful, and you can do everything online now regarding Social Security. We help clients sign up with Social Security all the time. SSA.gov is the website, and yeah, if there's any issues with getting logged in, again, why I suggest you do ahead of time is because then you can get those sorted out prior to wanting to get those benefits started. And what you'll find there is they'll have an electronic version of your statement, show you all of your earnings records over all the years, but Social Security is calculated using your highest 35 years of earnings. And that is what your benefit is based on. And it shows, on there what your Social Security taxes and the earnings that were subject to Social Security taxes, and then also what earnings were subject to Medicare taxes. There's different tax rates for Social Security and for Medicare, and that's all withheld from your paycheck. We call it the payroll tax, or it's the FICA tax is the technical term, and you pay one half of that, and your employer pays the other half of that. On that web page too, or on the statement, you'll also see what your benefits are at age 62. Should you decide to claim Social Security early, choose a reduced benefit, what that would be at age 62, what it would be at your full retirement age, and then also if you delay up to age 70, which is an option as well. So your full retirement age, as I mentioned, it is a moving target. It's based on your year of birth. So 1943 to 1954, full retirement age is age 66. And then if your year of birth is after that, you can see how your full retirement age increases up to age 67. So that is for everyone currently. Your full retirement age is no later than age 67. I mentioned you can delay it to age 70, so you do get a increased benefit if you do delay to age 70, and I'll show you how that works here. One of the things that is being discussed is, okay, the Social Security Administration, they do an annual report on the trust funds, and they talk about the fact that the trust funds, all the payroll tax that has been paid into the system has been in a surplus for many years up until the last few, and now there's a deficit. So there's more distributions coming out than there are inflows coming in through the current workforce. And eventually that surplus will be exhausted. That is projected to be about 2034 currently. And so there's always an annual report that discusses that, but also then comes up with some potential solutions. Some of them being increasing the full retirement age, so that's an option. Increasing the payroll tax, reducing current benefits, those are things that they do mention. I think that's highly unlikely that people will receive less benefits, especially folks that are currently on Social Security. I think it's more likely to see changes in the full retirement age and changes in the payroll tax. So the current workforce would be having to pay more for Social Security than it would be impacting the current retirees or the current beneficiaries of Social Security who are claiming Social Security. This is a little bit of the math behind collecting early versus collecting late. So as I mentioned, full retirement age, this example is based on full retirement age 66. So you receive 100% of your benefit if your full retirement age is age 66. If you begin early at age 62, you're going to receive 25% less. And if you delay up to age 70, you will receive 32% more. And, when you look at those numbers, it's a lot, but there's a period of time, especially if you're retired, where it's like, well, wait a minute, I'm needing income. I could be claiming Social Security, but I'm not. So if I'm pulling income out of my personal investments, am I comfortable with that? And, we help people make that decision all the time because that is a crucial decision to make. They do allow a do-over, a one-time do-over. If you do begin your Social Security benefit and you decide, what, that wasn't the right decision, you can pay it back. You have within the first 12 months of claiming it, you can pay it all back and act like it never happened. So some things to be aware of when it comes to Social Security. Here is a few kind of visual representations of the amount of dollars you would receive and the crossover points by claiming early versus delaying. So this dark blue line is claiming early. So early in this example would be $1,500 a month. So you receive that. And let's say you lived out to age 90. Well, by the time you pass away at age 90, you've received just over $500,000. This middle line, that's waiting to your full retirement age, so $2,000 a month. Age 90, you'd have nearly $600,000 that you've received over your lifetime. And then if you wait to age 70, so there's 8 less years between the first example and the second example, or excuse me, in the third example, 8 less years that you receive Social Security. However, you received a significant increase, so you've got over $1,000 a month more that you're receiving, $2,640 a month. By the end of your life, you're at, call it $770,000 that you've received over your lifetime. So it's, you know, there's a big delta, big difference between these amounts. The issue is it's spread out over all these years. In this example, nearly 28 years from the earliest claiming date at age 62. So that difference is spread out over a long period of time, and we don't know the date of death. It's just a thing that we don't know. So we have to make educated decisions around when's the best time to claim Social Security. If you see this cluster here around age 78 and 80, you'll notice that that's the crossover point. So that's, when we say late 70s, early 80s, if you feel like you have a high likelihood that you're going to live past that, then delaying could make sense. Now, there's a lot of other components into your financial plan that has to be considered. So, this answer on when to claim Social Security can't be just, provided in a vacuum. You've got to put all the pieces together and look at what that means for you. And if you're married too, what's the spousal benefit? Maybe they have their own benefit. What's the survivor benefit for either of you if one of the spouses passes away sooner than expected? So that all comes into the calculation, and we're able to provide a lot of information to help make those decisions. Now, some things to be aware of. If you do claim Social Security early, you have to be aware of the earnings thresholds. So when you claim Social Security before your full retirement age, so that first couple of slides there, full retirement age, let's say it's age 66. If you claim at age 62, you can't earn more than a certain dollar amount. And if you do, then you have to pay back your Social Security that you've been receiving. And what this applies to is what's called earned income. So it does not apply to IRA distributions, does not apply to like dividends, interest, and capital gains. That's not considered earned income. So you don't have to worry about those types of tax situations. All the IRS cares about, or all Social Security cares about, is what's earned income, which is typically W-2. So you're just an employee at a company, or self-employment income. So if you do own your own business and you have self-employment income, that would apply as well. But the penalty is for every $2 that you earn over $22,320, you have to pay back $1 of your Social Security that you received in that year. So something to be aware of if you are claiming Social Security early and potentially going back to work, or maybe taking a part-time job. Just be aware of these earnings thresholds. The year that you reach your full retirement age, there's a slightly different calculation. They do provide a little bit more of an amount. But then once you hit your full retirement age, like that month, you don't have to worry about it anymore. So once you hit, as I mentioned, age 66, if that's your full retirement age, and you just still are working and you want to turn on Social Security, you can, and there's no penalty. Now, Social Security would count as taxable income. There's a formula for that. You do get a portion of it tax-free, but it would count as taxable income that would be taxed on your tax return. A few things I mentioned already about solutions to fixing some of the shortfall estimates that are coming up here in the next decade, increasing the payroll tax, raising the income cap. So what this is, there's for Social Security specifically. So there's, two pieces, as I mentioned. There's Social Security tax, and then there's the Medicare tax, and those combined make up the payroll tax or the FICA tax. Social Security is capped once your income hits a certain dollar amount. In 2024, I believe it's in the $160,000 range, and that's per person. So, a married filing jointly, if they each have earned income, that's going to be subject to that. Once you hit that, the Social Security portion of the payroll tax stops. And then Medicare tax, that's a much smaller percentage. That has no cap to it. So they could raise that cap. That's another solution. I mentioned cutting benefits and increasing retirement ages, other ones. And then lastly, lowering the COLA, which stands for cost of living adjustment. So every year, Social Security increases the amount that you receive from Social Security by a formula that's based on the inflation rate. CPI is what they look at, and they could change how that's calculated. Maybe there's a cap, no more than 2%. Over the last several years, we've seen higher increases. Moving forward, we're back in the 2.5% range currently, but previous years. 2024 saw an increase of 3.2%. Prior to that, it was in the 5% range, 8% range, when inflation was significantly higher. So the idea being that Social Security is inflation adjusted, which has been very good, for folks over all these years. Now let's talk about Medicare too, because that's another key thing that you must consider as you approach retirement or eligible for Medicare. For most folks, it's age 65. If you do have a disability, potentially you could be eligible for Medicare sooner. But there's a couple of components to Medicare. So there's Part A, which is the hospital insurance, and there's no premium associated with that. You've been paying for that via the payroll tax your entire working career, so there's no additional premium. Part B is the medical insurance, and that changes every year. For the most part, it goes up. We've had this year, 2024, where it went, slightly, or 2023 went slightly lower, but it does increase pretty much every year. That amount is in the $170 range for most folks, and that's per person that is on Medicare. And then you have your drug coverage, which is represented by Part D. And again, that's around $12 to $20 a month or so for most folks. There are potential increased costs associated with your Part B and your Part D if your income is over certain dollar amounts. And we do a whole webinar. There's actually a replay that you can check out on all about Social Security, the different claiming strategies, and Medicare, and the different rules and regulations around Medicare as well, because there's a lot when it comes to both of those programs and things to be aware of. We are always evaluating these additional surcharges because it does hit people. If your income, taxable income, is over a certain dollar amount in retirement, then the government says you have to pay more for your medical insurance if you're on Medicare, and your prescription drug coverage. It is only for the 12-month period, so the year that for that 1 year. So if your income goes down in a subsequent year, then your surcharge would go lower or potentially just go away completely. So it's a year-by-year calculation that government does for you, and you can contest it. We've had actually a lot of folks that do contest it, especially when you are first retiring and they're looking at your income and they're saying your income's too high. You're like, well, I'm not working anymore. And a lot of times you're able to eliminate those surcharges. So, contact us if you have questions around how that works. And if you're looking at health insurance prior to age 65, there's a lot of planning that we do with Affordable Care Act and looking at the subsidies and how to maximize the subsidies for that as well. Yeah, this is, what we typically call kind of Medigap. Part C, Medicare Advantage, kind of wraps all this stuff together, where there's different premiums associated with that. And there's not necessarily a right or wrong answer. There's just different things for people to be aware of, depending on the route they go and what makes sense for them. We work very closely with a lot of Medicare brokers who are able to shop among all the carriers. It's very standardized within the government program, and they're able to educate you and evaluate for you what makes sense based on your unique situation. Now let's move into taxes too. I mean, that is just such a significant expense in retirement. You just, there's no getting around it. We look at taxes and do tax planning for our clients every single year, whether working or retired, because there's times when people are still working and there's some tax planning things to evaluate. And what we want to really understand is, what is our lifetime tax picture and how do we minimize that lifetime tax picture? And we have some ways we can model that in, and I've got some examples here later on in the webinar. Here are the current tax brackets for 2024. So we've got single filers here in this column. You can see there are 7 brackets. It starts as low as 10%, goes up to 37%, and we call these, these are marginal brackets. So as your income increases, the percentage tax you pay on that additional income increases. So it does not impact the lower levels of income. So for everybody, if you're single or married, that first row here, that's taxed at 10%. And then as your income goes up, that portion of your income that goes into the next bracket is taxed at 12. Next portion, if your income is high enough to go into the 22% bracket, it's all $1 into the next bracket does not trigger additional tax on the previous income. It's only that $1 that gets taxed at the higher rate. There are certain things that aren't necessarily that way, where $1 into like an IRMA threshold, as I mentioned for the Medicare planning, when you're $1 into a next tier, you pay all that additional Medicare surcharges on that amount. So we want to be very aware of what those are and where they're at. Everyone gets a portion of your income tax free. That's called the standard deduction. For single filers, it's $14,600. Married filers, $29,200. So if you do itemize, that is when you have certain expenses that are over and above the standard deduction, and those most commonly are your state and local taxes. That's capped at $10,000. Your charitable contributions, mortgage interest, and there can be some healthcare expenses. If you have a significant amount of healthcare expenses, that is potentially deductible for you as well. So those are the most common ways to actually get a larger deduction than the standard. For most filers, about 95, I've seen some data that says about 95% of filers are claiming the standard deduction, because that's a very high threshold to get over to be able to itemize. Capital gains, those are taxed slightly different. So that previous slide here, this was for ordinary income. So what counts as ordinary income? Well, that's W-2 income, self-employment income, IRA distributions, pension income, annuities. Those are all ordinary income, and that all gets added together and taxed at those rates. Capital gains and qualified dividends are slightly different. So qualified dividend, it's a dividend that is paid to you from, there's specific kind of criteria, but most companies pay qualified dividends. And then capital gains, so that is when you invest money in something and then you sell it in the future for a gain, a positive return. And there was some talk during the campaigns for the most recent election that around taxing unrealized capital gains. I think that would be very difficult to enact and would encourage probably a lot of argument over what are things actually worth. So, but capital gains, they're only taxed when you realize the gain. So when you have to sell something to then generate the tax currently. This is the capital gains brackets for a married couple. So a single filer, it would be cut in half, approximately. But when your income, so that very first slide that I showed on our tax planning, section here, if your income is below 94,000, so you add up all your, whether it's W-2 or IRA distributions, you add it all up, you subtract your deductions. If your taxable income is less than that, 94,000, if you're married, then that you have no tax on those capital gains up till the amount you hit 94,000. So here's an example. Let's say your taxable income is $60,000. Well, you have $34,000 that you could be utilizing to generate capital income, capital gains, and pay no tax. That's something that people, and you got to do it during the calendar year. That's a lot of the stuff that we're going to be showing here in these next few slides with our examples. A lot of the planning has to happen between January 1 and December 31. There's a few things that the IRS allows you to wait until you prepare your taxes. So, you don't prepare your taxes until Q1 the following year. Start getting your tax documents in January, early February, start looking at it, have up until March, up until April. And, unless you extend it, which you then have up until October to put everything together and file your taxes. But you're very limited in what you can do after the fact. So we've got to do a lot of planning during the calendar year to understand how do we maximize our tax situation. We want to minimize our lifetime tax bill. So I've got some case studies here, which will show the examples of the planning that we're able to utilize to help folks minimize their tax, tax liabilities. So this case study, Bill and Judy Sample, both age 66, they're both receiving Social Security. The combined amount is $42,500. They're taking an IRA distribution of $70,000. They don't have enough to itemize, so they're claiming the standard deduction, which is common for most folks. And because they're over age 65 and they're not itemizing, they're each able to take an additional deduction. It's $1,550 per person over age 65. So for both of them, that's $3,100. They need $8,000 a month. So we're going to work up a tax calculation for them. I'm going to kind of walk you through what this looks like, but this is our summary of our tax calculations. So first and foremost, we've got kind of their income. So they're going to have some account values here on the right hand side. Social Security, IRA distribution 70,000, Social Security 42,500, total income. So this is gross income 112,500. Now let's look at the deductions. So we're going to take off the portion that is not taxable. So the standard deduction, 29,200 comes right off, age 65 deduction, 3,100, and then a portion of their Social Security is tax-free. There's a formula called provisional income that we go through on our Social Security webinar that runs through how Social Security is taxed. So they get $6,375 of the $42,500 they're receiving from Social Security. So that's 15%. They receive 15% of their Social Security tax-free. So we add all of that up to give us their total deductions. So there's $38,675 that they don't pay tax on. They receive that tax-free. We subtract that from the $112,500 from their gross income to to arrive at their taxable income. And then taxable income is what flows through the tax brackets. They're a married couple filing jointly, so their first $23,200 is taxed at 10%. And we can do the math on what that is. This is from a federal standpoint. And then the portion from $23,200 to $73,825 is taxed at 12%. Now the top of the 12% bracket is higher, so they're in the 12% bracket currently. We do the math on that. That gives us $6,075. We add those together. Total federal tax is $8,395. And then we did, a mock Kansas return as if they were a Kansas resident, and they would have $2,186 in tax owed for Kansas, giving us their total tax bill of $10,581. So let's kind of summarize this. Total income, $112,000. Total taxes, $10,500. Their effective tax rate. So we take the total tax divided in their income to give us their effective rate, 9.4%. Subtract the tax owed on their total income, giving us their after-tax income divided by 12, gives us nearly $8,400 a month. So when you're working, you're used to probably only receiving 70% of your paycheck, 60% of your paycheck, maybe 50% of your paycheck, depending on, certain things. And it's because, well, you're paying the FICA tax. So while they're retired, they're not paying that payroll tax anymore. So they don't pay, they pay tax on Social Security as income, but they're not paying, additional payroll tax because they're not employed. They're not earning any income. They have taxable income, but it's not earned income. And then you've got, your medical expenses and things like that when you're working. Those all come out of your paycheck. If you're saving in your retirement plan or sending money to, different savings accounts, those all come out. So, you're used to receiving just a portion of your paycheck versus in retirement, your tax situation is significantly different. So, I think it's helpful for people to understand what that looks like. Now what we do when we have our baseline kind of tax situation, and then we look at, well, how do we reduce their tax liability? What are the things that they're doing that they may not be receiving a tax benefit for, but they could be? So for example, they're making $10,000 a year in charitable contributions. They like to do that every year, send that to their church, but it's not enough to itemize, because the charitable contributions plus the state and local taxes plus mortgage interest, which they don't have any, it would all have to add up to be over, actually more than $29,200, because you get this age 65 deduction. That amount is actually closer to $32,300. So they don't have enough of these expenses to add up over the threshold to itemize. So we look at, well, how could they itemize? Is there a way for us to structure their retirement account in such a way that would allow them to itemize? Well, they do have some after-tax investments. So, when you have different accounts, there's different tax consequences for the types of accounts that you own. So, for example, when you have a retirement account, so that's typically your 401k, transfers potentially when you retire into an IRA. Well, that money was contributed most likely on a pre-tax basis. That's the most common way to make contributions into those retirement accounts, is pre-tax contributions. So you get a tax deduction in the year you make the contribution while you're working. And then that money grows tax deferred all the time up until you start taking distributions. And then when you take distributions from your retirement accounts, it's taxed as ordinary income. You could be contributing to a Roth IRA. That is where, you pay the tax today and you get tax-free growth. That's a great, great tool, great strategy. Or you could be saving outside of those accounts in what we call like a taxable account or a brokerage account. So that's money outside of those retirement accounts, and you have access to those funds at any moment because you've already paid tax on it. Now you could, like your checking and savings, those are after-tax funds. You're not taxed again when you take the amount out. Now, if you take some excess savings out of your savings or checkings account and then you invest it, you only pay tax on those capital gains and dividends and interest. As I mentioned, there's a little different tax calculation for those types of accounts, and capital gains are only taxed when you realize them. So one of the things that they have is they have an after-tax account. They've invested in that, and they bought a stock 5 years ago for $25,000. It's worth $50,000 today. They've owned it for 5 years. So what we want to look at is, well, they're very confident they're going to continue making those charitable contributions. So we want to make sure that, that's first and foremost. So you're going to continue to do that. And they are. Well, could we lump together 5 years of your charitable contributions into a single year? And we can do that utilizing an account called a donor advised fund. And there's two ways you can make contributions to a donor advised fund. You can put in cash, so just a total dollar amount, or you can put in investments, stocks, bonds, mutual funds. Those can all be transferred into a donor advised fund. And many custodians that manage these donor advised funds, we custody with Charles Schwab. They have donor advised funds. They can even own privately held stock, real estate, things that are less liquid. Those are also options as well. Well, if they were to sell the stock and then donate the cash, they're going to have to pay a capital gain on the difference between what they paid for it, $25,000, and what it's worth, $50,000. But they could also just transfer the stock directly into the donor advised fund. And there's two tax savings when you do that. One, you avoid the capital gains tax. If they were, if they had higher income and they had a 15% rate on their tax on their capital gains, well, that tax, the 15% on 25K would be $3,750 in federal taxes. So they avoid that just by transferring the stock into the donor advised fund. And when the money goes in the donor advised fund, at that point, it's considered given to charity. And the donor advised fund most likely is going to sell that stock and diversify it. You have control over the donor advised fund. A lot of them don't allow you to just hold individual stocks like that, or at least highly concentrated individual stocks like that. If your balance is big enough, potentially they'll allow you to do some of that, but most likely they're going to recommend that you sell that stock and diversify that. The other tax savings is that they're able to claim an itemized deduction. And, if they didn't have, their itemized deduction would be higher than this, but this is just for simplicity's sake. Let's say their itemized deduction is $50,000, the amount of the charitable contribution, but they'd have state and local taxes as a additional amount added to that. But it's higher than the $32,300 standard deduction. So that gives them an additional $2,124 in tax savings. So they could just continue what they're doing, making $10,000 a year out of their checking account to making those checks out to their church, and they wouldn't have any tax benefit. Or we can lump together 5 years of contributions and generate a nearly $6,000 savings in federal taxes. There'd be some state tax savings on top of that as well. So this is where planning really makes a difference into making sure you're looking at your accounts and your assets in such a way to minimize your tax bill, maximize your tax situation, while even if you're still working. There's a lot of this as potential, but even in retirement as well. Now, another charitable strategy is utilizing what's called a qualified charitable distribution. So now we have folks that are slightly older. So we're going to fast forward with Bill and Judy, say they're now age 73, and they're subject to taking required minimum distributions. So earlier when I mentioned the IRA, and when you take distributions out of your IRA, you've deferred all that tax, and so those distributions that come out of your IRA are taxed as ordinary income. And when you do that, you're paying all that tax each year. Well, at some point, and you're not forced to do it until a certain point in the future, because the IRS says, well, wait a minute, we're tired of this money sitting here not generating any tax revenue for us. We're going to force you to take it out. And that's what the required minimum distribution represents. It's a forced distribution. And it begins, for folks now at age 73, it's a moving target. As time goes on, it'll increase to age 75. It used to be 70 and a half. Now it's, changed over the last few years. Their Social Security's had cost of living increases, so their combined Social Security amount is nearly $48,000. And then their IRA has increased in value, and the RMD that they're required to take out is $91,250. Again, not enough to itemize, standard deduction, charitable contributions. They're still doing the $10,000 per year. They put in the $50,000, 5 years from 66 all the way up to 71. They're now 73, and they have these required minimum distributions. And the after-tax account, didn't want to continue with the donor advised contributions because we can utilize this qualified charitable distribution strategy, which is slightly different. Then here's their age 65 deduction. Now, what we're going to look at, if they take their RMD, the $91,250, and they receive it, it gets deposited into their checking account. And then they go turn around and then write a check to their church for $10,000 the next day. They don't get any tax benefit for that, because they don't have enough to itemize. Their total tax liability on this situation that we just went over would be $15,400. What the IRS allows you to do is once this number's slightly different than your required minimum distribution age, but once you reach age 70 and a half, that's the old required minimum distribution age, but it also is the age for qualified charitable distributions. Once you reach that age, you can send money out of your IRA directly to a charity, and it does not count as income. So it comes out of your IRA, and it just goes direct to the charity. It doesn't go to you first. And when you do that, reduces your IRA balance. Once you're age 73 and you're required to take these distributions, you're also able to count that amount that you send directly to a charity towards the required amount you're supposed to take out. So in this situation, if all they do, they're still sending $10,000 to the church. They're just instead of it coming to them first and then them writing a check, they're just sending it directly out of the IRA. That reduced their tax bill by nearly $2,300. Just that one thing, which was a 15% tax savings by just changing the account that the funds come out of. So these qualified charitable distributions are very important for people to look at, especially if you're making donations to charities. We want to really think about our tax situation over time, and the best way to do that. I mean, for some folks, they've got majority of their assets in their retirement accounts, and it's all pre-tax money. It is what it is, and that's fine. There's still a lot of planning around that, Roth conversions, things like that we're going to talk about. But if you're able to save money in Roth IRAs while you're working, or in non-qualified accounts, or what we call taxable accounts, so your checking savings, your brokerage accounts, then that gives you some different options for tax control in the future. So having these different types of accounts definitely makes a difference. Now, I talked about making a decision around Social Security in a vacuum, and it's like that's very difficult to do because there's just so many moving parts. Well, where are you going to pull income from if you need it when you're not claiming Social Security? So what we do for folks, and this is for every single client of ours, we sit down with them at least once a year, and we go over their retirement plan, their lifestyle retirement plan, and we're always updating it. And it's because this is a process that's dynamic. We want to say, all right, every single year, let's look at what we, here's what we said we're going to do. Here's what happened. How did the investments perform? How did income come in? Are there any tax moves we need to make during the current, calendar year to minimize our tax liability or future tax liability? And then what is our income needs, expenses? What do we think they're going to be in next year and future years? Are there big expenses coming up? We're constantly having these conversations because you can't put a plan together at age 62 and then just assume that plan's going to be, you've had the next 30 years figured out. There's not one person that I know knows exactly what it's going to be for the next 30 years. So updating the plan is the key part of this, because your life changes, things happen, health changes and priorities change. If you have children, maybe there's grandkids in the picture and they now live in a different place and you want to move closer to them. That may not have been in the picture when you retired, but now is in the picture today. So a lot of different things to be aware of and constantly evaluate. And the biggest thing is, when you put a plan together, especially when you're first going through this process, one, all these different things are things that people are they feel more educated, more confident, and more in control of their financial future. It's not just happening to them, but you're being more aware and more intentional about, here's what I want in retirement. And you may not know exactly everything. That's not, you don't have to have everything figured out. It's just, let's just start with step one. And a lot of it's just, hey, I want to retire and I want to spend a certain amount of money, or at least this is what I'm currently clearing on my paycheck. Let's just start with that. And then we can back into a lot of different things after that. But we want to answer the question, am I going to be okay? Because, people, they don't want to outlive their retirement savings or be a burden to their family in the future. So having a plan in place and updating that plan on a regular basis is extremely important. I'm going to go through some pages of our plan. And here's what we put together and what we're constantly updating. We're looking at the investment accounts. What are the values of those accounts? Updating them every single time that we sit down. If some of these accounts, maybe there's a 529 account, which is specific to educational expenses. Okay, well, how do we use that? Well, that's not going to be a fund all goals. That's going to be assigned to an educational goal for for somebody in the future. What other assets do we have? Typically it's a residence and some vehicles. Vehicles come and go, maybe not be as crucial to have always updated, but you definitely want to track the value of your primary residence, especially if you own that residence. Do you have any debt, mortgage, related to that? What what that allows us to do is just put a snapshot every single time, we sit down, put a snapshot together of net worth. What are our investment assets? What are our other assets? I mean, other assets could also be businesses and things like that too. Is there any insurances, life insurance? Are there insurances that have cash value associated with that? If you're still working, maybe you have stock options as part of that, or company stock, a private stock, and we can track all that for you on a regular basis. Liabilities, how does that compare to to your overall assets? And then that gives us your net worth. I think that's important to update on a regular basis. And then we update inflows into the plan. So maybe someone has some part-time work. We're going to maybe show that. Pension income for sure that we would keep track of. Farm income if you have that. Rental income. But Social Security is going to be the big thing that we're going to be updating on a routine basis. We're able to stay on top of that pretty well, but occasionally, people have some changes there. And then, so that's a snapshot of okay, here's where we are. Now it's, well, what are we trying to accomplish? What's the spending plan look like? For this couple, okay, retired in 2023. They want to spend $9,000 a month net of taxes. Once their mortgage drops off in 2038, they're not going to need to replace the principal and interest portion of their mortgage payment. Judy, we anticipate, might live a year or two longer, and her expenses at that point might be slightly less. What's their health insurance? Well, they're age 66, so they're going to be on Medicare. estimate what their Medicare Part B, Part D premiums are for them, any out-of-pocket expenses that that we can estimate for them, get in status kind of on the health side of things, and then other goals that they have. They want to travel, purchase vehicles throughout retirement. They have a home remodel that they're currently going through, and these goals change. That's like the home remodel, that came up, but there could be another one in 10 years. We don't have to have that all planned out and figured out, but we want to just have these pieces in here and update them on a routine basis. And these are all cumulative goals too, by the way. So they're additive. And then they're not just fixed either. We assume that they're going to increase in cost over time. That's the cost of living, increases associated with that. This is one thing that we track is what their spending is going to be in the future, and that's just to maintain their lifestyle. So that first year we had 108,000 after taxes, and we had some other, Medicare expenses on top of that too. But by the time they're both near it, when it's Bill's age 90, they're spending $245,000 net of taxes. And that's not an increase in lifestyle, because that's just keeping up with inflation. And of that, nearly $40,000 is spent on healthcare. We track those expenses separately. We take that, then, we take the inputs, the data that we entered into the plan, and what the goals are, and then we run a stress test. It's 1,000 simulations. It's good markets, bad markets, different rates of return, different orders of return, and we come back with a probability of success. And we want that to be between 75 and 90% probable. And we always get a lot of questions on that. They're like, no, I want it to be 100% probable. It's like, well, we can't. There isn't 100% probability that this will work in the future for everyone. But what this probability of success, what it means is that what is the likelihood that a change may be necessary in the future? It may not happen. It may never need to change. But based on the inputs that we put in there, is it possible that one of them might need to adjust? So the lower the score is, the more likelihood a change would need to happen in the future. So for example, we have their travel budget. Well, if this was a lower score, we might say, well, at some point that travel budget you might have to skip a year. It doesn't mean you've got to cut your spending in half and all these other things. It just, at some point you might have to skip a year. But it may not. We just want to make sure everyone's aware of the probabilities of success for these plans. And that's why we're always updating them too, because the plans change, the investments, change. I mean, most of the time they go up in value. 7 out of every 10 years, the stock market, the investments, the bonds, they're higher than they were the previous year. But there's 3 out of every 10 years where the market's down. And, we account for that in our modeling here, because we run, again, 1,000 simulations where we're showing good years, bad years. We're showing multiple bad years in a row, things that have never happened. The other part of this too is then we're able to plug in the Social Security analysis and say, okay, well, for that scenario, that was an 86% probability of success. That was them claiming Social Security at their full retirement age 66. Well, what if they delayed to age 70? Well, that increases their probability of success to 92%. So a pretty good bump there. Now, the break-even point is the age they must live beyond to make waiting make sense. So that pushes it out to age 80. So we're going to talk about that and see if they're comfortable with it. That's where we can evaluate Social Security. People also ask, well, how much money are we going to have at the end of the plan? Well, we don't know. I mean, does that mean we're going to just, the day we die, is our last check going to bounce? And it's, as great as we'd like to be able to have that precise of planning, it's just really difficult to do. So we can come up again with ranges of future account values. This top number here, that's the top 1% of those 1,000 simulations, which, those are the best ones, the top 1%. That says they're going to pass away with $13 million. Well, that's not likely to happen. And I show that because this is the bottom 1%. These are the outliers on the bell curve. It says that they're going to run out of money in 2043. Well, those have the same probability of happening. Those aren't going to happen. Between this is the meat of the bell curve here, between this on the high end here, the 75th percentile all the way down to the 25th percentile, you can see there's quite a range here, 4.5 million to 1.1 million. That's several $1 million difference, but that's a range of reasonable expectations. I mean, again, because there's a lot of things that we just don't know about the future, especially when it comes to investment returns and the range of those returns and the order of those returns. And that's why we're always updating the plan. Now, we use very conservative assumptions when we do have our capital assets pricing. When we put those estimates in there, we're assuming forward returns are lower than they have been historically. And there isn't any reason for someone to say, well, in the future, it's going to be worse than it was in the past. I mean, people can project that. That's an opinion, based on some analysis they might do, but it doesn't mean that's going to happen. I've seen a lot of people talk about bonds and how bonds are just going to be a terrible investment in the future. And it's like, yeah, bond rates went up in 2022 and they had a bad year that year, but then they've had good years since then. So, people project things that aren't necessarily going to happen. So history is our best guide, but we're going to just say, well, let's just be a little bit more conservative. And that's why our plan results end up over time showing increases in the plan. This is part of our tax planning process. We look at someone's lifetime tax picture. And so this is a visual representation here of where their income is coming from. What type of account is the income coming from? The red is retirement accounts. The blue is now Social Security when that kicks in. The green is the required minimum distributions. These are different years that have larger expenses associated with them. And then we have in the background these solid lines, and those represent the tax brackets. The 12% bracket, the 22% bracket, the 24, 32, that's what those represent. And so as the income goes up, you can see where they land in their tax bracket. And this is with doing nothing, what they're no strategies. We just kind of model that out. Now, we don't know exactly what the account balances are going to be to say exactly what the tax situation is going to be, but based on our conservative assumptions, what we think they could be in the future. We then say, okay, well, what if we want to convert money to a Roth IRA? Well, how do we know if that's a good decision or not? Well, what we can do is say, let's model that in. So when you convert money to a Roth IRA, that's when you take money out of your IRA, your traditional IRA, you pay the tax, and then you move it into a Roth IRA. And what we said for this person is said, okay, this yellow is a Roth conversion up to the top of the 24% bracket. And we're going to do that for several years up until they reach the required minimum distribution age. So does by paying more tax today save them money in the future? And that's what this looks at. It says right now, based on everything that we have, everything we've modeled in, there's a $36,000 tax savings by paying more tax today than you're required to. And the reason is because these required minimum distributions are less, because when we convert money to a Roth IRA, comes out of the traditional IRA, and the Roth IRA does not have a required minimum distribution. You're not forced to take money out of that account at any point in the future. So we're putting more and more money over there, not forced. We can spend it, but you're not forced to take distributions out of it, and it doesn't trigger any income tax when you do spend it, and that's reducing their lifetime tax liability by $36,000. And that's just based on current tax law. If tax law changes, if it gets worse, well, that would save them even more money, if they're going to pay higher taxes in the future. Or even based on our conservative assumptions, if the account balances are higher than we have, this is also going to be a much larger savings to them in the future, which is very likely. What this next situation looks at is a qualified charitable distribution. So let's add that to our Roth conversion strategy. So once they hit age 70 and a half, they're able to also send money to charity. And, how does that help them? Because that reduces their required minimum distribution. So it reduces their tax bill. You can see that adds another, nearly $30,000 to their lifetime tax savings by just, and they're making those charitable contributions anyway. That's the key to that. If you're making those contributions, you don't necessarily save money by, if you weren't doing that, you're only getting a portion of it back on your tax return. So, it's one of those things where if you're doing it, how do we maximize it? So we can model in how that looks. And we can look at, okay, well, we're paying more taxes today, but then we're saving all these taxes in the future. And again, this is a year by year conversation with our clients on this tax planning, because it's important to understand, okay, where they're at, because we can model in everything for the next 30 years, but we don't know exactly what the balances are going to be. We don't know what their retirement spending goals are, what the tax situation is going to look like, because that's going to be fluid with Congress over time. But the key is to put a plan in place and update that plan. That is such a key component to this this process. So, we just want to help people live more enjoyable lives with some smarter financial planning. It's a just important thing for us, and we're very very adamant about putting these plans together, and we're willing to sit down with people. There's no cost to do that. We have a planning team here that's able to sit down with you and help you model all this stuff out. And if there's a fit for us to work together, we'll explain to you how that works. And if there's nothing that we can help with, or you've got everything you need, then great. That's our process. It's not a sales pitch. You're not sitting there like you're going to a timeshare deal. I mean, it's our planners are professionals. They have the CFP designation, or they're working towards that CFP designation. They aren't master salespeople. So I encourage you all, if you haven't sat down with us and gone through that process, to do that. Again, check us out. Our replays there on KeenWealthAdvisors.com under the Retirement Resources tab. If you'd like a copy of Bill's book, send me an email, mwilson@KeenWealthAdvisors.com. Happy to send you a personalized copy of the book. And then lastly, our YouTube channel, Keen Wealth, youtube.com/@KeenWealthAdvisors. You'll see additional content that you won't see anywhere else. Well, thank you all for joining me today. I appreciate all of your participation. Thank you for sending in your questions. That helps model in some of the material that we're going to discuss. So if there's anything that, any additional questions you have, again, feel free to shoot me an email, mwilson@KeenWealthAdvisors.com.